Hey everyone, Michael Brooks with Perfetta Capital, and so I am going to do a deep dive into the investment philosophy where I'm going to describe, I'm going to go for it here. It's going to be a lot of info, but I hope to go through it quickly. I want to get through this investment philosophy page here that really does explain, and I'm going to give sort of kind of my experience over the lifetime of me being an advisor, give you a few stories, and just explain how I would explain to a client who's trying to get to know me how I see markets and how I see constructing portfolios for clients. Okay? So I've listed kind of as much as I can on this page, which is my investing page on my website. So I'm going to start from here and then kind of go down sort of the bullet points and explain together. But first, I want to start with sort of my history and where I began, the things that I have learned over time, and hopefully this will just get us to understand over all this time that I've been an advisor, which I really, technically I started as an advisor in 2008, but since my father was in the investment industry, I really knew a lot about being a financial advisor through a combination of working for him through the summer, through talking to him all the time about his business, helping him with computer systems and filing and doing all that. Before even that time, I've been involved in the investment industry since about 2003. So I have over 20 years of looking at markets, understanding how we used to do things and construct portfolios. Some things along the way that we learned, some very difficult times that we went through, and some things that we've learned since. So really, if we go back and we look at that time where early 2000s, we kind of came out of this .com bust. The enthusiasm from the 80s and 90s was punctured by this enthusiasm for tech stocks. Now, it's not like the market was completely wrong about the nature of tech being the future. I mean, the internet was just beginning in the mid-90s. Some of us remember it well with our old Netscape browsers. But then, the idea of businesses being created out of that to have the kind of valuations that they did, and unfortunately those businesses weren't fleshed out fully yet, and the expectations began to be so lofty that it caused realization to kick in and a market crash to ensue, and your average tech stock, the NASDAQ fell, for instance, 70% in a very short period of time. So through that, immediately I was in a state of, okay, well, being greedy on the side of going for the momentum and the winners only wasn't the best of ideas. And to really, especially for retirees or those who were close to retirement, that didn't make much sense to be in a position where you could lose something like a 70% on your portfolio value. So that was, lesson number one is don't lose money that much and to that degree. So don't be in the first place in a position to capture that kind of loss. Okay, so that was number one. And then when I actually became an advisor, again, wonderful timing, in 2008. And I moved from New York, where I first started in finance, and moved down to Atlanta. Then 2008 happened. We went through that financial crisis with the subprime mortgage debt crisis, and that also opened up a whole can of worms in the investment world, where you really started to see a huge shift in from just trying to have stock pickers, finding the best mutual fund who had the best performance, to, hey, we need to preserve capital as much as we can because we cannot have a 2008 happen again. And unfortunately, that strategy didn't work because that forced others to go way too conservative, and it led to a whole series of investment philosophies or strategies that we saw over and over again. I mean, I met with many professionals, those who worked for investment firms who were selling their strategies to advisors. Many of them had all sorts of different ways that they would try to come up with trying to outsmart the market, I would say. Things like momentum strategies, or getting in and out of the market based on their algorithm, and trying to find those top points and the low points and getting in and out of stocks. And throughout those years after 2008, those all were dreadful. I mean, terrible, had horrible performance. And so those were not the right way either. And over time, I started to realize that, the whole approach that advisors had started to go down, either out of fear of losing clients if they had, were going to bail when markets were down, was a real problem that I had to solve. And so, I think that from that point, I started to really gravitate towards this more strategic, as we call it, or more of a buy and hold investment philosophy. And I'm going to go through that now. So just to give you sort of the history and the evolvement over my time, where saw a lot of volatility, saw two big market corrections or crashes throughout my early years, saw the response from investment markets to have products to come up with solutions that overcorrected and then missed a lot of the upside that came out of 2009 throughout the subsequent next 2 decades there, almost up until where we are now, where the S&P just took off like a rocket, and anything that was super hyper conservative or out of line just underperformed dreadfully. I mean, Warren Buffett made a bet against hedge funds that the S&P would outperform their average over a long period of time. I think 5 or 10 years when he made this bet, and he was completely right. He destroyed hedge fund managers, and so really this is where we lie. I mean, and this goes for one of the beauties of how we've done. I've done this, and I think this is really important. Is this works for everybody? I mean, very sophisticated investors who have tons of money. Your high net worth folks will take extreme advantage out of the efficiencies of the way we're constructing portfolios, the ETF structure itself, which I'll have to get to in another video, but really the low cost nature of it, that's what your more sophisticated investors are looking for. Your high net worth investors are looking for, hey, I know the S&P, we can buy that easy, cheap, but is there anything else that we can do to get some kind of outperformance? Okay? So that's the history there, and I'm going to tell you, what we should do, what you should know, and how we should go forward. So in the first point here, when we're talking about active fund performance, I mean, this is the way that a lot of folks were investing their money for a very long period of time. I mean, I remember when I was back working for my dad during summers I even have some clients now that we had back 20 plus years ago that I was doing this kind of work for, which was putting together portfolios for clients that was structured with mutual funds, 10 or 12 of them that covered all sorts of different asset classes. And then I would fax those orders, buy and sell orders of the amount of dollars that we needed to fulfill that buy or sell order for portfolios, and we were faxing them in to the custodian in order to get those trades filled. Obviously, now we have much better technology. We can do it all online, and we have, with the ETF structure, we are able to trade daily just like we would a stock portfolio. But needless to say, it's much easier now. But we're in this first point, we're comparing against mutual funds because they were a huge part of what the everyday investor was invested in. Probably most of you have mutual funds because if you have a 401k, you're most likely invested in mutual funds in that 401k. ETFs haven't taken a huge adoption rate yet, so you're most likely in this scenario. And the popular thing to do, especially in the 80s and 90s, was to have active fund managers. And basically a manager was a person or a team that was picking individual stocks to go into that fund, and they were trying to pick stocks that would outperform, an index like an S&P or a NASDAQ or a Dow. And so the likelihood of them beating that index, you can see here the statistics that have been pulled for over time, is that we have a very low success rate, and this success rate has been so bad that it has led to an astronomical amount of money going into index funds instead of actively managed. So, the idea of the stockbroker, the guy who is picking individual stocks for your portfolio, or the idea of an actively managed mutual fund that is trying to outperform the market over time, rarely has worked. And in fact, I love this chart right here where it says, of the top 25 ranked funds, how often are those funds 5 years later still at their top quartile? We're still in the top 25% of funds in their performance. And look again, it's not even close. If it's not at 50-50, it's low. It's 22% in the stock world that you were still an outperformer 5 years later. So the ability for the average investor, the ability for a professional investor to pick mutual funds that worked for the long term was nigh impossible. Okay, so is there a more reliable way to do it? Well, yes, we turn to indexes where we are not picking individual stocks in order to try to outperform the market. We're picking the index, and we go with the index, and we try to avoid predicting the future, and we just go with the index, and you way outperformed inflation, and you did fantastic if you just stuck to an index. As you can see, returns in different asset classes, astronomical returns if you just buy and held large or small cap stocks, for instance, over long periods of time. That strategy works really well. But can we do better? And this is our argument for why an Avantis is a preferable choice to something like, why don't you just buy the S&P 500 ETF and call it a day? Well, here's one reason, and this gets a little bit in the weeds. We don't have to go into a lot of detail, but I'm going to summarize it by the fact that most index funds are trading to follow the index once a year. And I love this analogy. It's sort of like shopping for roses on Valentine's Day, where everybody goes and buys it all at the same time. Well, they're going to raise the prices because they know that a lot of people are going to go shopping at that time. The more people that buy stuff, the higher the prices get on that particular day. And so you can be losing out in an index compared to a strategy that might trade all throughout the year. And so if you're setting yourself up for success here, what we can do is have a more effective and efficient approach. And by doing that, we can identify some drivers of long-term outperformance, okay? And we're able to do this flexibly by trading throughout the year and tweaking the portfolio slightly in order to get our rebalances, the stocks in the right percentages and in the right order all throughout the year, rather than just limiting it to one time per year. Okay, so we do this by higher expected returns, and I'm going to get to that detail in a minute after I finish this part, because it's requires a little bit more explanation. Okay, so let me just finish up these last couple of points, and then I'll get to that in a second. So I talked a little bit through this in asset allocation, so I'm not going to belabor this point. Again, we're going to have to do a deeper dive into international versus U.S. stocks, but just to say, again, we should diversify internationally, and I have very good reasons why now is a better time than we've seen in a long time, why international investing makes even more sense, but we'll get to that in another video. Just a reminder that, Uncle Bob that you hear stories from down the street with his hot stock tips, show me history, show me a real strategy that worked, that is replicatable. And I call anyone who gives me these hot tips or, hey, buy this stock now, quite silly. I mean, this is not the kind of advice that is professional. It doesn't necessarily have any weight or academic backing. Just tune out the noise. I mean, the Kramers, Jim Cramer has been studied by professional investors, and there was a study on how often he was right about a particular stock or about an idea that he came up with on his show, and he's 50-50. I mean, he's 50% right, and there's other studies of showing very, very top tier. I mean, very highly respected investment research teams, Schwab, Stifel, all these investment teams being all over the board as far as their predictions. So tune out the noise. Predictions are again, in my opinion, are impossible, much less we want to avoid following them, because they could be dreadfully wrong. And I don't believe in them. I don't have a crystal ball, and neither do you. And neither does the guy down the street. And so what we do is we set up the portfolio right in the first place, not trying to predict what's going to happen in the next 6 months to a year. Okay? Now, this is another subject we'll have to go a lot more in depth on, and I will talk about a lot in future videos, but when the market does have a big correction, and when this is why I have a job, is I am that counterbalance to investors really panicking or falling into the fear trap of when markets really do have a bad correction. What do we do? What actions do we take? And unfortunately, my answer to a lot of this doesn't feel good to some people, but the reality is to stay invested, because you miss some of the best days of the market ever is in down markets. And so if you miss those, you don't get the timing right on both sides, both the sell side or the buy side, then you're going to underperform. And this could be, again, these mistakes, especially the more net worth you have, the higher portfolio value you have, can be very bad mistakes. They can be very impactful to your retirement, to making huge decisions like, hey, can I, use this money to outlive my retirement, and give something to my heirs or not. I mean, these investment decisions can be very impactful, and we've seen it time and time again. I've seen clients come in with, hey, I did this, with my previous advisor, and he had me in this, and then it dropped 50, 60%. Seen it a lot. And so I am trying to avoid that for my clients by us really coming together and understanding what your portfolio structure is and that it is appropriate. For younger folks, I say, come on, let's go. We have time. We're going to recover. And obviously for the older folks, we're going to not be in that position in the first place, and not put your retirement income at risk. Okay. A last point that is interesting. I get this question a lot. When is the right time to invest? And so if someone is saying, hey, I got an inheritance, or I got this big chunk of money from a house sale, but markets are at all-time highs, like they are right now. What should I do? Should I hold off and wait for, I'm worried about what's going on in the world. I don't know. I'm not confident that, we're going to see a lot, the next 6 months. What are we going to see? Maybe I should wait and hold off on investing. I believe that any time is a good time, because it's not the way that stocks work. Stocks are priced to deliver an expected return over time, and they're priced now this way for a reason. And so your typical, old school advice of buy low and sell high is, in my opinion, a myth. It doesn't, it sounds great, but the implementation of that and being able, again, to do that over and over again consistently, and I'm talking about consistently over decades, again, is what we have seen through mutual funds, trying to pick individual stocks, trying to outperform the market and failing. And so I'm going to show you how we try to outperform the index through high profitability and low prices. And that's how Avantis is using the portfolio to try to outperform the markets over long periods of time. So let me show you what we're talking about. Now, again, this can get a little complicated, and I'm not going to explain all of what these terms mean in the chart. I just want to get to the bottom line and the point here. And that is, if we take the whole market, like every stock out there, and this applies, by the way, for U.S. stocks and international, all across the board. These kinds of drivers of returns, it has been studied and found in any kind of market. Okay, so not just U.S. stocks, but international as well. This is inherently a nature of how stocks and markets work, and this to me is the only way that has been proven to, over time, provide outperformance, and that's through finding expected returns. But look, we have a modern way of finding this approach that Avantis has come up with, and that's why I feel so confident, and that's why I'm using it for my clients. I mean, again, I have the ability to go anywhere and do anything in the investment arena. That's a wonderful thing about being an independent RIA. And my job as an independent RIA is to be as unbiased as possible, giving the best that I can for my clients. It's my fiduciary duty to my clients. And this is what I've settled on. This is what you pay me for, to find, through my experience, the best answer to the problem of constructing portfolios. And so this, to me, is the way. Okay? So what is this chart trying to show? Well, really, it's just trying to show that if we break up the all the stocks in that we can that we look at in all the different markets. What we're trying to show is where are we going to tilt the portfolio? If we're not just following the index, where can we find a little bit of that outperformance? And it's by looking at kind of at a couple different metrics, and there's ratios involved in here to get to these terms, book to market or profitability. But bottom line is we want to be in this top right quadrant, okay? And that is a combination of both low prices and high profitability. And so we identify the companies through those metrics. So there are, every company has these. They're public information. If they're a public company, we have the data. It's all there. And we're looking at these ratios and identifying companies that happen to have low prices but have high profits, and then tilting the portfolio to have higher weightings of those companies in the fund compared to the index like the S&P. Okay? Now, we'll have times when this will underperform. There will be times right now, for instance, we are in a extremely aggressive large cap, mega cap growth bull market. So your large growth companies have far exceeded any other asset class. And in the next video, I'm going to talk about concentration. And actually, that's starting to have a little bit of a question mark this year, as we've seen some of your major names, the Mag 7 stocks really underperform this year. And Tesla, for instance, is an example, down 14% so far. Nvidia has not done not nearly as well as last year. And we're starting to see some shaky ground there. But basically, the composition and the concentration that you can find in an index compared to how we're doing it in here, where we're tilting towards this low cost but high profitability, we're going to have far less of the Magnificent Seven stock exposure in our Avantis funds. Therefore, we may see higher performance this year than, for instance, a year like 2023 or 4, where the market was really concentrated and those stocks carried a lot of the gains for those particular years. Okay? So anyway, low cost, high profitability, tilting the portfolio towards that, diversifying across many different asset classes, many different stocks, trading throughout the year, being active in that portion, but not trying to identify we believe or we think this stock is going to outperform, or we're going to use the force to feel that this stock is going to outperform the market over the next 5 to 10 years. And then we're going to determine when to get out. That is inefficient. You don't know when to get out, when to get in, when to get out at the right timing, because we don't have a crystal ball. It is a tax burden. You have capital gains to deal with. That it becomes a very big headache and a drain on returns. And look, this is simple. We have 5-6 funds depending on the portfolio and how much fixed income we need for the ballast of the asset allocation. But we can accomplish a full out. Our portfolio has thousands of stocks in them, but it can be accomplished with just a few ETFs. So again, for the complication aspect of it, we want to keep it simple. We want to keep it inexpensive, and we want to cover our bases through having a lot of diversification. And we want to make sure that we're not being inefficient with the trading and trading throughout the year. And we want to identify companies that have high profitability and are also low cost at this particular time. We weight the index towards that, and we try to outperform over long periods of time. Okay, so that's how that's the philosophy. How I've come through the years to settle on where I'm at. Now, it doesn't mean that things can't change. Look, I'm doing things differently now than I was 10 years ago. And that just comes with either updated research and more effective tools to do what we can do, or something else could come along that could change how we feel about things. I mean, there could be a massive global meltdown. I don't know. These things happen, but I keep my eye on the ball, and I really think that this really is going to cover us for a long period of time. And I think it's the best that I've found for my clients. And so that's my investment philosophy. Thanks for paying attention, and appreciate it. See you in the next one.